In this video, we will look at how stock market indices are actually built. You can think of a stock market index as a basket of stocks that represents a specific market or sector. But not every basket is put together the same way. There are four main methods we use to assign importance or weight to the different stocks in these indices. Today, we are going to walk through each of them: market capitalization, free float, price weighted, and equal weighted indices. Let's start with the most common one, the market capitalization weighted index. To understand this, we first need to know what market capitalization is. In simple terms, it's just the total market value of a company. You calculate it by taking the total number of shares a company has and multiplying that by its current stock price. For example, if a company called ABC has 5 crore shares and each share costs 120 rupees, the company's market cap is 600 crores. In this type of index, the bigger the company's value, the more influence it has on the index's movement. To see how this works in practice, imagine we started an index back on January 1st, 1995. We take 5 different stocks, calculate the market cap for each, and add them all up. In our example, the total starting value was 18,800 lakhs. We then give this starting point a simple base value of 100 to make it easy to track. Now, look at what happens over time as prices change. If those same stocks now have a total market cap of 42,500 lakhs, we compare that to our starting 18,800. What this means is our index value has climbed from 100 to about 226. That's a 126% increase. In this system, you'll notice that stocks with higher prices or more shares naturally start to take up a bigger piece of the pie. Famous Indian indices like the Sensex and Nifty were originally designed this way. However, there's a slight variation of this called the free float market capitalization index. In many companies, not all shares are available for regular people to buy and sell. Some might be locked away by the company's founders, known as promoters, or held by the government. A free float index only looks at the shares that are actually available for immediate trading in the market. Today, this has become the global standard, and it's how major indices like the Nifty, 50 and Sensex operate right now. Next, let's look at the price weighted index. Here, price is king. In this model, the size of the company doesn't matter as much as the price of a single share. Imagine a balance scale. A stock priced at 450 rupees will have a much heavier influence than a stock priced at 100 rupees. Even if the 100 rupee company is actually much larger overall. To calculate this, you simply add up the prices of all the stocks in the index and divide by the number of stocks. If the total of our stock prices grows from 1,250 to 2,550, the index value moves from 250 to 510, which is a 104% gain. While this isn't as common today, some of the world's most famous indices, like the Dow Jones Industrial Average in the US and the Nikkei 225 inches Japan, still use this price weighted method. Finally, we have the equal weighted index. As the name suggests, every stock in this index gets an equal vote, regardless of its price or its size. If you have 4 stocks, each one is given exactly 25% of the weight. To make this work, the index manager has to adjust the number of shares for each company so that the total value invested in each one is the same at the start. The interesting part here is what happens when prices start moving. If one stock's price shoots up, it suddenly represents more than its 25% share. To fix this, the fund manager has to perform a rebalancing act. What this means is they will sell some of the stocks that went up in price and use that money to buy more of the stocks that fell. This process restored the balance so that every company once again has an equal influence on the index.